Good morning, this is Bloomberg Daybreak Europe. Happy Wednesday. I'm Tom McKenzie in London. These are the stories that set your agenda. The dollar edges higher. Treasuries trim recent gains. Traders stick to forecasts for 2 rate cuts next year, as data shows the US labour market continuing to cool. Oil rebounds from its lowest level since 2021 after President Trump orders a complete blockade of sanctioned tankers going into and out of Venezuela. Plus, Bloomberg learns that Warner Brothers is preparing to reject Paramount's hostile bid as the US president's son-in-law withdraws from the takeover battle. So after a mixed picture on the labour market front on the jobs data out of the US yesterday, unemployment ticking up to 4.6%, but the November non-farm payrolls coming in slightly higher than estimated. You've got a mixed end to the session on Wall Street, with gains actually coming through for the Nasdaq 100 and a little bit of weakness on the S&P 500, closing down by about 0.2%. The European picture right now, futures pointing to very modest gains of 0.1%. FTSE 100 futures looking to add just 19 points, holding above that 9,700 level. S&P E-minis then largely unchanged. Nasdaq 100 futures, after the modest gains of yesterday, pointing lower by just 22 points. Looking for the next catalyst. Maybe that's the inflation data that comes out of the US on Thursday. Talking inflation data, we get CPI out 7 a.m. UK time for the UK, so keep an eye on the pound on that. 133 right now, a little softer on dollar strength in the session. The pound down 0.3%. The US benchmark 10-year 416 yields up just 2 basis points. So a little bit of selling, as we said in the headlines, when it comes to US Treasuries. But again, the market bets into 2026 for the Fed have not materially changed on the back of the jobs data that came through yesterday. Maybe inflation changes that tomorrow. Brent at $59 a barrel, then up 1.4% on the Venezuela story, and gold closing in on a fresh record high. Silver is already there, 4,334 per troy ounce on gold, up 0.7% in today's session. Let's cross over to Asia right now. Winnie Su standing by in Tokyo. Strength in Korea, some gains coming through on mainland China, but broadly pretty mixed.
Yeah, exactly. We are seeing a bit of a stabilization in the Asian market here today. As you can see, the overall MSCI Asia slightly up to the upside, especially after that big sell-off yesterday as investors look past the U.S. jobs data. And like you mentioned, specifically leading gains today are the Korean stocks with these chip makers, including Samsung, SK Hynix rebounding. But also to flag that the HSCEI here also pulling slightly back away from that technical correction level that we had yesterday amid the concerns around economic weakness and also tech valuations. Now we flip the board and take a look at what's going on in the Japanese market as we really look ahead of look into the Bank of Japan's decision meeting later this week. Here the topics in the Nikkei gaining slightly, but also just really consolidating around those levels, specifically for the Japanese yen, also hovering around that 150 level against the dollar. Now, for the yields, we are seeing the yields up about 2 basis points, and that is still around those concerns for fiscal budget. We've got local media saying that right now the government is likely to have their fiscal 2026 budget at around topping about 120 trillion Japanese yen. So a bit of a concern there in terms of kind of that bigger budget that we're expecting going forward. Now, we flip the board and also take a look at the highlight today in terms of individual stock, because it is the Chinese chip maker Meta X's debut day today in Shanghai, and look at the stocks up about 700% there, with about 3,000 times oversubscription. So it is a lot of excitement for another Chinese chip maker, and it really reminds us of that earlier IPO by More Threads earlier this month. Similar moves, and actually it was founded by someone who used to work at NVIDIA, and this time around Meta X founded by someone ex-AMD, manufacturing GPU chips, and also account for about 1% of China's AI chip market as of last year. So you can really see lots of excitement around China's AI development and just how the industry is likely to have a further boost going forward. Back to you, Tom.
Wow, up almost 700%. That is quite the paper gain, isn't it? And a reminder of the domestic chip play in China. Winnie Su in Tokyo, thank you very much indeed. Let's get to what's happening in the energy space then with geopolitics and the overlay there, because US President Donald Trump is ordering a complete blockade of sanctioned oil tankers moving in and out of Venezuela. The move increases, of course, pressure on Caracas amid a US military buildup in the region. Let's bring in Bloomberg's Stephen Stupczynski now for the oil market perspective on this. Stephen, why is Trump blockading Venezuela? What is the rationale?
You know, I think you can look at this as a play for regime change. I think, he's been putting pressure on this regime, and one way to tighten that pressure even more would obviously be taking one of their biggest revenue areas, and that's oil. Putting curbs on their oil exports. Already, he's been tightening that through the seizure of a ship earlier this month, as well as just restrictions in general, have helped to curb the amount of money flowing into Venezuela and in particular U.S. dollars. But by doing this, you're really siphoning off a very large portion of the revenues from that the regime can get. Now, there are a few reasons for this. One, Trump has for a long time blamed Venezuela for a flood of drugs coming to the country. You've seen the U.S. administration hit several, over a dozen ships that were suspected of carrying drugs and being involved with the cartels. He's also blamed Venezuela for a surge in illegal immigrants coming into the country, which is something that he struck quite hard during the campaign trail. So, of course, this is sort of a ratcheting up of this pressure, and it's in the onset that we're in a bit of a market glut. The U.S. is producing a lot of oil. Prices are pretty weak. So with all that together, Trump and the administration thought that this was their time to strike.
Yeah, and we can see that, can't we, when we check the oil market. So, yes, we're seeing a move of almost 1.5% up on oil prices, but Brent is still below $60 a barrel. So, Stephen, what does it mean? How central does Venezuela play? What kind of the centrality of that nation in terms of its oil exports onto the market, and how this could affect pricing going forward?
I think this is more sentiment-driven, any increase that we see today, than really actual changes in the fundamentals for the oil market. Because, listen, Venezuela last month was producing or exporting roughly 500 to 600,000 barrels a day. Now, to put that into perspective, the global oil market consumes about 100 million barrels a day, so that's less than 1%. So if you remove even all of that, and that's not what Trump is suggesting. He's suggesting just the shadow fleet ships, these dark sanctioned ships, which make up a portion, but not all, of the export from Venezuela, you're not going to be really changing the fundamentals very much, but it does show some sort of discombobulation in the market. There is obviously there's going to be some degree of scramble. A lot of that oil was going to China. Where do they find the replacements? Are there the grades that they can find elsewhere to feed their industries? That's going to be something in focus. But when you do zoom out, a 1% gain is nothing compared to where we're sitting in the oil market. We had prices fall just recently this week to the lowest level since 2021. Oil prices are weak. There is a glut that is expected to get worse in 2026. So even if you were removing these Venezuelan barrels from the market for a prolonged period of time, you're not going to be seeing a sustained increase. In fact, there's probably more downside for the oil market.
Okay. Stephen Stupczynski, excellent analysis, and the latest in terms of that blockade by President Trump around Venezuela. Stephen, thank you. And the oil market reaction to that, of course, the implications going forward. Meanwhile, traders are sticking to bets for 2 Fed rate cuts next year. That's after a delayed US jobs report pointed to continued cooling in the US labour market. Attention now turns to inflation data, which is out tomorrow. Let's bring in Bloomberg's Valerie Teitel. So there was a lot of noise, Val, in the data, as you had expected when you sat down with us this time yesterday morning, and you warned that it was going to be a messy data set. What stood out for you yesterday?
Well, look, the market clearly shrugged off some pretty decently bad data because of these nuances around the data collection and larger standard errors than we normally get in a BLS survey. So it was kind of a deer in the headlights reaction to this number. The market really didn't know what to make of it. Perhaps we're waiting for Fed members themselves to give us their opinion on what they thought of the data yesterday, and we can able to break through the noise. noise, but there was a few reasons why the market shrugged off some of these decently bad prints. One of them was the October non-farm payrolls that showed a contraction of 105K. That was largely shrugged off as issues with the government shutdown. It was government workers that really dragged down October payrolls to essentially the lowest reading we've had since the pandemic. The other thing that the market shrugged off was the rise in the unemployment rate. It rose more than expected to 4.6%, the highest in 4 years and a tenth higher than the market expected. This was not because of the government shutdown, but because of some interesting factors I wanted to discuss. One of those was a decently large pickup in unemployment of the teenage bracket, the 16 to 19-year-olds. That made up nearly 70% of the rise in the unemployment rate yesterday. There was also a near historic rise in those classified as part-time for economic reasons. Now, that normally doesn't happen outside a severe recession, but I think the way the market explained this away is the fact that the BLS collected this data so close to the Thanksgiving break. It captured those re-entering the workforce looking for part-time work over the holiday season, some teenagers maybe having some free time after exams looking for employment, and those looking for extra employment to maybe subsidize holiday budgets into December. So those were two nuances. And also, just overall, the BLS did warn us that there were larger statistical errors in this print that did come true. There also was a very low response rate in the November household survey. So all of this taken together means that the market shrugged off the weak data. Now, perhaps some attention from some of these points by Fed speakers later today could give us a reassessment of what we've heard.
Well, on that point, so markets still pricing in 2 cuts from the Fed. We know the dot plots and the forecasts are for 1. What have we been hearing from Fed officials? Are we getting closer to alignment or further divergence on that point?
Look, it does sound like we're getting closer to closer alignment within the dissenters. We did hear from Goolsbee overnight. He was talking to CNN. He was the new hawkish dissenter in last week's decision, but he actually told CNN that the job market looks like it's cooling at a modest pace and that he would actually favor continuing to cut rates next year. So it seems like it was enough for him to get off the fence to say that, look, he wasn't necessarily dissenting at December's decision because he doesn't want to cut rates any further. He was just waiting for more clarity. Now, he isn't necessarily stressing a lot of concern on the labor market. He said gradual cooling. It was a modest pace. These are kind of things that don't necessarily stress urgency. Now, we could hear that later today from Governor Chris Waller. He before has classified the labor market as flashing red. So it'll be very interesting to see how his take of yesterday's data will come. And perhaps the market might put even more weight on it now. We had a report from the Wall Street Journal that Waller is going to be interviewed by Trump later today for the Fed chair position. So the Fed chair race being opening up wide. Perhaps maybe listen to what Christopher Waller has to say today with that emphasis.
He's not out of the race.
He's not out.
It's not just the two Kevins. Chris is involved as well. All right, Values Hotel, thank you very much indeed. Worth noting, we showed a screen there. We showed a shot of the unemployment rate in the US at 4.7%. That is not correct. It is at 4.6%. That is the unemployment number officially that came through in the data set yesterday. US unemployment at 4.6%. So just marking that correction for you. So we apologise for that. 4.6%, not 4.7%. Now, let's get to the data around the UK. UK unemployment climbing to its highest level in almost 5 years, and wage growth easing. The data supporting the case then for the Bank of England to cut interest rates tomorrow, arguably. Let's bring in Bloomberg's Ven Ram, cross-asset strategist for Bloomberg Markets Live. We get inflation data out of the UK at 7 a.m. UK time as well. So, Ven, all of this data, you can make the case, and there are those doing this, that data that we've seen out of the UK is reinforcing the case for a BOV cut, 25 basis points on Thursday. Is there anything that could derail that? Does inflation today potentially put a risk, the view that this is essentially locked in for the BOE?
Morning, Tom. Absolutely. I think that the inflation numbers that are forecast for November is supposed to come in at 3.5% and thereabouts. And I think that, what the markets are broadly looking for is a disinflationary print, i.e. a lower number than in October. But if we get a mildly disinflationary print, yes, maybe a rate cut is nailed on. But what happens if we get a tick higher? Then that will upend the question about, whether we are indeed in a disinflationary environment. And what we have seen this week is, if you look at the wage growth data, we saw a wage growth of 4.5%. And if you see the private sector wage growth, it's 4%. And if you look at services inflation, we are hovering around 4.5%. So the question, the big question for the BOE is, we all know that they are going to be cutting rates more in the cycle. The question is whether they should be cutting it tomorrow, as early as tomorrow, because inflation is clearly not in control. We have had one inflation print below 2% in the past 4 years. So the question is one of urgency, not one of whether they will cut. And I'm not too sure whether Andrew Bailey is going to say, yes, you know what, we've got sufficient evidence of disinflation. So I think that the markets are signing more than a 90% chance of a rate cut. I think that's a bit over emphatic. I think that the vote is going to be a lot closer than that.
Okay, very interesting. Of course, Bailey has been that swing voter, and Ven Ram has been consistent on caution around how far the BOE is likely to go, given the stickiness of inflation here in the UK. Ven Ram, thank you very much indeed, as we lead up to that inflation print out of the UK, of course, 7 a.m. UK time, and then the BOE decision tomorrow. Coming up, a shake-up in the battle for Warner Brothers after Jared Kushner's Affinity Partners pulls out of Paramount's takeover bid. We bring you the story next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Warner Brothers is understood to be planning to reject Paramount's hostile takeover bid as a major backer walks away from the deal. Affinity Partners, Jared Kushner's private equity firm, is exiting from the takeover battle. For the latest, let's bring in Bloomberg's deals reporter, Manuel Baigori. Manuel, why is Kushner's Affinity Partners walking away? Is this arguably a belated wake-up to the potential conflict of interest or another reason?
Yes, Tom, that's a very good point that you just made. It is true that the takeover battle for Warner Brothers became kind of controversial, highly political. Donald Trump himself made it clear that the deal should have, a very, very deep antitrust review, and that he would personally get involved as well. It's a very, very transformative deal for the entertainment industry in the U.S., also with ramifications globally, given the scale of these businesses. But yes, I think to your point on the conflict of interest, definitely the deal escalated and became, kind of like a very, very controversial topic of discussion all over the media. So definitely there was a little bit of that. And also, obviously, what they're saying, more on the record, is that the deal dynamics have changed since they became involved in the discussions back in October. And that is also partially true because now we're seeing a fierce competition between two global powers. We've got Netflix on the one hand, Paramount on the other hand, battling out, who's going to get Warner Brothers. And interestingly, we are now seeing that Warner Brothers, according to our sources, is expected to reject the takeover bid, the hostile bid by Paramount pretty soon, potentially as soon as today.
So, Manuel, where does this leave the takeover battle then?
Yes, what a saga, Tom, isn't it? It's just like worth of a show in its own way. But the next steps remain to be seen. I think the most imminent one, as I was just mentioning, is the potential rejection by Warner Brothers as soon as today, urging shareholders to reject the tender offer by Paramount. That should be the most imminent step. But then, obviously, we'll see how Paramount reacts, whether they withdraw the bid or whether they make any tweaks, whether there is any other financing proposals that come together to ease some of those concerns that we understand is the main issue for Warner Brothers to recommend the offer. So tweaks could be made around financing, or potentially Paramount could just walk away. It will be interesting to see also how Netflix reacts to all this. For now, they've got an agreed deal with Warner Brothers, so it's mostly Warner Brothers to respond and also Paramount to make a move either way.
Okay, the twists and turns. Yeah, and that breakup fee, $5 billion for Netflix, vis-a-vis that tie-up with Warner Brothers. Manuel Baigorri with the details. Bloomberg's deals reporter. Manuel, as ever, thank you for the update. Coming up, California warns Tesla its sales could be suspended for 30 days if it doesn't change its marketing practices. We'll bring you the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Tesla's shares ticked higher in late trade, despite news that its sales in California are poised to be suspended for 30 days. It's the most important market, of course, in the US. Let's bring in Bloomberg transport reporter Danny Lee in Hong Kong. Danny, what are the potential issues, what are the specific issues, I should say, facing Tesla in the great state of California?
Yeah, Tesla is facing this 30-day suspension, and this revolves around the California Department of Motor Vehicles taking issue with some of Tesla's marketing literature around its use of autopilot and full self-driving. Now, the ramifications of this is there's a suspension in place of this ban for the next 90 days, and that gives Tesla, importantly, the breathing room to respond and whether they comply with this ruling or whether they appeal. It remains to be seen at this stage, but clearly the stock reaction in post-market trading overnight was an immediate 2.2% decline before pairing those losses. Now you can see in the pre-market the stock is up, and that really just follows what happened on Wall Street's close. The fact that Tesla shares hit a new high and now making it worth $1.63 trillion. And that has been fueled by optimism that investors see in Tesla's AI, robotics, and its automated driving kind of tech, and really does contrast really with the kind of struggles that it still sees in its core business of EVs. And so, yeah, for California, putting the pressure on Tesla, this could have a hit to Tesla's business because of, as you said, it's California's its biggest market, and also it has such a large production output out in California. So we're watching very closely to see what happens in that state.
OK, an important update. Bloomberg transport reporter Danny Lee on Tesla and its prospects in California. Joining us out of Hong Kong, Danny, thank you. Now, some other stories making the news this Wednesday. OpenAI is in initial discussions to raise at least $10 billion from Amazon and use its chips, a potential win for the online retailer's efforts to broaden its AI industry presence. Bloomberg understands that the deal under discussion could value OpenAI north of $500 billion and see it adopt Amazon's Trainium chip. But talks are at an early stage and terms could change. Meanwhile, former UK Chancellor George Osborne is joining OpenAI. He will lead its OpenAI for Countries program, which is aimed at helping governments increase their AI capacity. The White House Chief of Staff, meanwhile, Susie Wiles, has made candid remarks about President Trump's inner circle in an interview with Vanity Fair magazine. Wiles described Vice President J.D. Vance as, quote, conspiracy theorist, and Tesla CEO Elon Musk as a, quote, avowed ketamine user. The White House downplayed the remarks, with Wiles saying in a social media post that, quote, significant context was disregarded. And Waymo is said to be in discussions to raise more than $15 billion at a valuation near $100 billion in a financing round led by its parent company, Alphabet. The company has achieved an annual revenue run rate above $350 million. The robotaxi maker is the front runner in a race against Tesla and others to turn autonomous ride-hailing into a business. Coming up, mounting tensions as the US threatens to retaliate against EU companies over digital taxes. We'll get reaction from Eurostack's Christina Caffarra. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The dollar edges higher. Treasuries trim recent gains. Traders sticking to forecasts for 2 rate cuts next year as data shows the US labour market continuing to cool. Oil rebounds from its lowest level since 2021 after President Trump orders a complete blockade of sanctioned tankers going into and out of Venezuela, plus tech in the crosshairs, mounting tensions as the US threatens EU firms with retaliation over digital taxes and regulation. We're going to break down the companies that could be caught up. Let's get you some breaking news right now when it comes to the defence space. This is KNDS, said to plan a dual listing in Paris and Frankfurt in 2026. This is the tank maker, said to confirm IPO plans as soon as this week, an IPO that would be launched in 2026. This is, according to our own reporting, KND's board has decided to pursue that IPO amid surging demand for defence stocks and potential interest from rival Rheinmetall. Let's get more details right now and bring in Bloomberg's chief Europe correspondent, Oliver Crook, who follows the European defence space very closely. Ollie, what more do we know?
Yeah, so KNDS is this company that builds a Leopard 2 tank along with Rheinmetall, so it's a major player within the sort of defense architecture of Europe, and obviously it's one of the companies that wants to capitalize on all of the euphoria sort of pouring into the sector. So what we understand now is there were some questions about whether Rheinmetall would pursue a merger and acquisition of KNDS. We actually asked Armin Papberger, the CEO of Rheinmetall, about that a couple of weeks ago when I spoke to him, and he said, listen, we don't really talk about M&A until we're a week away from closing because anything could happen. For example, the company could go public, and we understand that that is what the board has opted to do for KNDS. They'd like to take the company public. We understand they will have a valuation of about 20 billion euros. That will make it one of the biggest companies on the stock 600 aerospace and defense, the 10th biggest. They make the Leopard 2 tank, and there was, of course, this merger potential speculation with Rheinmetall. That seems to put that to the side for the time being with this IPO going forward and a dual listing, we should say, of some interest between Frankfurt and Paris. This is a company that is headquarters in the Netherlands and is, of course, right now held by the French state and a private German family, I should say. But now it seems that it will be access to other shareholders who will be able to buy some of these shares potentially as soon as next year.
OK, Bloomberg's chief Europe correspondent Oliver Crook with that latest on a potential IPO in the defence space in 2026. Ollie, thank you. Let's get to the broader markets right now then. Dollar strength is part of the story. A little bit of a sell-off when it comes to US Treasuries. Let's get the picture up in terms of the futures story. You did see some softness when it comes to European stocks yesterday at the close, ending down about 0.5%. Today, European futures pointing modestly higher by 0.2%. Here in the UK, FTSE 100 futures looking to add 20 points. Inflation data out of the UK at 7 a.m. UK time. S&P E-minis pointing to very modest gains of 0.1%, and Nasdaq 100 futures looking to add 19 points. Let's flip the board and have a look cross-asset. As I mentioned, a little bit of selling coming through for US Treasuries. A mixed picture when it comes to the jobs data out of the US. Unemployment ticking up to 4.6%. 4.16 on the benchmark 10-year yields, up 2 basis points. The pound, again, in focus around the inflation data, 133. A little softer, but that's more about a dollar strength story in the session today, down 0.3%. Brent crude, of course, oil prices in focus as a result of that potential blockade around Venezuela, up 1.4%, but still below $60 a barrel. And silver breaking a fresh record high. This has almost doubled, more than doubled in price, in fact, year-to-date silver, and up 3.6%. Look at that in the session, above $66 per troy ounce. So it's not just gold that's made those gains. Silver, in fact, has outstripped gold year-to-date. Now, the Trump administration, switching focus, is threatening to retaliate against the EU over efforts to tax American tech companies. The Office of the U.S. Trade Representative said in a social media post it would use, quote, every tool at its disposal to counsel or counter the EU's measures. The department singled out prominent European companies, including Accenture, Siemens and Spotify, as possible targets. The EU has increasingly ramped up efforts to regulate US tech giants, including Alphabet's Google, Meta and Amazon, imposing fines worth hundreds of millions of dollars. What a great moment then, an important moment to bring in Christina Caffarra, who is founder and chair of Eurostat. Christina took part in shaping Europe's digital infrastructure and regulations. Christina, great to have you in the show this morning. Let's start on this news then, your reaction to this threat of retaliation from the US.
Well, this is the ramp-up of a rhetoric that has been swirling around for some time, at least since the summer. And the framing of it is particularly telling. The way in which the administration is framing the current opposition to what Europe is doing is in terms of a tax, a digital tax, and a discrimination against successful American companies. There was a hearing yesterday at the House Judiciary in which this narrative was really blown out. The whole discussion was these Europeans are effectively failures and they are seeking to extract rents and taxes from successful American companies. This is all a ruse. It was even framed in terms of a foreign conspiracy against American successful companies. So this is really...
Does the US have a point at all?
Absolutely not in the framing, in the sense that this is not how antitrust works. This is simply the fact that we are having antitrust laws, we have regulation, and the regulation, the causality works as follows. You're a big company, you do something which is breaching the law, and then you get fined, and then you get told to stop. So these are not taxes. They're framed as taxes to appeal to the home audience, of course, because it does feel unfair. But it is normal, even in the US, to fine a company which is found in breach of the antitrust laws.
So Europe should hold the line on this?
The irony of all of this is these laws don't do very much. And this is where the complication really arises, because while we are defending them staunchly, and in a sense, what else could we do? We regard them as a manifestation of our very sovereignty, the essence of our sovereignty, the hill on which we die. In reality, these laws are not doing very much for Europe. It is an effort to nibble at the margin these companies. They are slow-moving, they don't do much, they don't achieve almost anything for Europe. So we are caught in a curious dilemma in which we appear to have to defend what is our rule of law when our rule of law is not doing much for us. And so the Trump administration is being weaponized by these companies who find these rules and regulation annoying. They're not existential, they're just annoying, to just step back.
On regulation, you've said there's too much moralizing in Europe, too much of a focus on values and think tanks, and we need to move away from that.
This is very much something we need to wake up to. Europe is traditionally getting on the high horse that we have higher moral values, we have, defending our Western democracy, and that is the justification for what we're doing in terms of regulation. Regulation only makes any sense if you're achieving something on the ground, if you're moving the dial. But the real question, and the irony of all of this kerfuffle, is that these rules, while they are very annoying to the companies and the administration, really, as I said, don't do much for Europe. So Europe has essentially neglected to do the thing that was, in fact, much more important, which is build our own tech. The reason we are finding ourselves where we are is because we are a digital colony, fundamentally, of American suppliers. And this is not because they necessarily have done something awfully wrong. They have filled the vacuum that Europe has left. You are an effective, successful company, you have a market to fill. And Europe has been sort of thinking, shall we just tame them a little bit? But this isn't the way to progress.
So what does Europe need to do? What is the prescription? You're saying it's not a problem of talent and it's not a problem of capital.
It's not a problem of talent and not of capital. Europe is especially good at finding excuses. So the Americans are too good. The Americans don't understand our products. No, we have the talent and the capability. This is the moment for Europe. We are realizing that we are a digital colony and the geopolitical, geoeconomic reality demands that we step up. The good news is that we have what it takes. What is absolutely necessary is essentially a attitude, approach, and vision. This has been what's missing. Europe institutionally is constituted the way it is. Nobody makes a decision. It's all very fluid. Nobody moves on. There is no leadership. There is no vision. But the reality is that industry is actually now saying that's enough. We are just going to move. And I think we are going to see a great deal of confidence in European tech, both from the perspective of industry itself. We have some of the best pieces. Even in AI, we have incredible AI capabilities. Even in chips, we have a portion of the chip stack in which we are extremely effective. And capital is there. Europe saves twice as much as the US in every year. The 1.4 trillion euros is saved by Europeans, saves. US is half of that. And 300 billion of that goes into the US for investment instead of staying in Europe. We are hemorrhaging talent and money, which we must keep back.
You're saying that Europe can learn lessons from China as well?
China is extraordinary because through focus and effort, they have gone from absolutely nowhere 15 years ago in tech to being a very successful challenger and now close to the US in a number of places, so much so that they, of course, worry the US's arrival. And the way they have done it is, of course, focus, investment. They've shown that even the gigantism that we hear all the time is necessary to develop AI LLMs, forests of GPU, lakes of data, enormous volumes of compute. That's not necessary because they've developed AI models that don't rely on that gigantic thing. They have got essential resources, the rare minerals, and of course the US is trying, of course, to position itself with this packed silica to try and fill its own gaps there. So China is an example to follow. We are worried about them in so many dimensions, but China has made it, and it is unconscionable that Europe, with the talent, the capability, and the capital that we have a capital allocation issue, not a capital formation issue.
Christina, thank you very much.
Thank you.
Indeed, we could take this conversation much further.
Can.
I've got 101 other questions, but we're running short of time.
Thank you so much
Fantastic
for
coming
having
into
me.
the studio and with the reaction as well to the news of the day around the Trump administration's threats of retaliation aimed squarely at some of Europe's key tech players, including the likes of Siemens and Spotify as well. Christina Caffarra, founder and chair of Eurostack. Meanwhile, in the energy space, the CEO of Totalenergies says he expects rising demand for oil to underpin prices, despite their recent slump. Patrick Poyen says he believes the market will stabilise as the US and OPEC producers work to keep oversupply in check. He's been speaking exclusively with Bloomberg's Francine Lacroix.
I trust also OPEC countries to manage the situation. You've seen them beginning to slow down. They are relinquish oil in the market. If the price is too low, you have a sort of natural counterbalance in the US shale oil, because then the US shale oil producer begin to slow down themselves. So at the end of the day, what I'm sure in economy, demand equals supply. So then the rest is going to inventories and the price will adapt. But the world is not linear. Since I'm CEO, I've seen it going down from 100 to 17, 27, 80. We have, last 3 years, it was almost at $80, $70. So it was very good, I know. But it will go down and then it will rebound. It will rebound because fundamentally, because of the energy transition, I think we don't invest enough in this oil business. And so if they slow down, then you will see price will go up again.
So you're the biggest exporters, of course, of US LNG to Europe. Do you worry about prices there, that they put extra pressure?
It's very important what you just said.
Yeah.
Because I read recently an editorial in the Wall Street Journal which was accusing us not to be good US citizens. We are, and nowadays, we are the #1 exporter of US energy to Europe. We are fully committed to US energy. We are investing $20 billion in new plants in US energy. We have this year sanctioned an additional train in next decade in Rio Grande. We are the largest one, #1.
When sanctions are lifted, if sanctions are lifted, are you ready back to do business, or are there other considerations?
We will obey, for sure, to all the European regulations. So Europe has recently decided that they want to stop imports of LNG from Russia. We will stop import of LNG from Russia. There is no doubt. Yeah. Today we have continued. It's well known. We are importing LNG from Yamal because it was part of the security of supply scheme. I said myself to the European leaders, from 27 there will be enough coming from the US. So you can replace the Russian energy without having an impact on the market. 26 is in between. I don't know. Today we see a little lower, but honestly $10 is quite a good high price, still a high price. So I would say 26, no, I think the gas price will remain, I would say, comfortable. 27, I think will go down.
When sanctions are lifted on Russian gas and oil, what will you do?
We'll see. I'm not sure they will be lifted quickly. We'll see. As this scenario, we'll see what we will do. It depends. For sure, investing a lot in Russia, not, to be clear. We have some lessons. We were quite a big investor in Russia, almost $15 billion of investments. We draw some lessons. We have made a big write-off of 4 assets there. So, the world is big. So today we have shifted from Russia to the US. This will be maintained. Then we will observe. You know, it will take time because it's a matter of trust. And you know, in this business, in energy, you invest for 10, 15 years. So building the trust is just fundamental. It's not a matter of geopolitics. It's, for me, the matter will the board of Totalenergies trust to put a lot of money in Russia? Today, it will take time. We'll need to be sure that if there is a peace, this peace is sustainable.
The Totalenergies CEO speaking exclusively to Francine Lacroix, of course, of Bloomberg. Coming up, solid spending saw US retail sales little changed in October. We're going to be discussing the outlook for consumers ahead of the holidays. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, US retail sales were little changed in October. Solid spending across several categories was muted by a decline at motor vehicle dealers. For more on the outlook for retail and consumers ahead of the holiday season, very pleased to say we can bring in Deanne Evans, Managing Director EMEA at Shopify. Thanks for coming in. How healthy is the consumer? What are you seeing in terms of consumer trends as we lead up to this crucial holiday season then?
Yes, look, so Tom, we've just come off one of the biggest holiday shopping weekends of the year, right? Black Friday. And what we saw during that time was that consumer spending was up 27% year over year for retailers that are on Shopify. So what does that mean? $14.6 billion in sales over the Black Friday, Cyber Monday weekend, which is incredible. And some of the categories that we're seeing, people are spending fitness and nutrition, apparel, right? They're buying from brands that they love. They're buying from brands that they know and trust. But one of the things that we did see is that consumers said they were going to be intentional with their spending. So, you know, they set a budget, they stuck to that budget, but they did come out and they did spend with retailers that were on Shopify.
How is AI changing the way that we buy and the way that that retailers sell?
Yeah, so it's, I mean, from the way that we buy, what we're seeing is that consumers are really shopping everywhere. So as a retailer, what you have to think about is your consumer is going to go, they're going to go to TikTok. They're going to look at social media. Then they might go online. Then they might talk to an AI agent. Then they might go in store and maybe back online to make that purchase, right? And what we heard from consumers ahead of this holiday spending was that they were going to be spending both online and in store about 50-50. But we know that these channels, really these retail channels everywhere, AI, they're using it to shop. They're looking at social media. They're doing this across the board. And so if you're not across all those channels as a retailer, you're going to be missing out.
OK, that's a complex challenge, arguably, for retailers then. What other key consumer trends and changes are you seeing this year versus last year, for example?
Yeah, absolutely. So like I said, what we're seeing is that we're seeing brands, we're really seeing consumers buy from brands that they trust, right, brands that they know. And what they're doing is they're also spending with brands that are doing things a little bit different. While they're looking for discounts, of course, intentionality is reigning there. They're also spending with brands that are doing things like looking at, we have a great brand, Finisterre. What they do is they actually do a Blue Friday sale, and they're raising money for charity. So what consumers are doing is they're also looking at who are the brands that align with my values. So they want to spend money with brands that are not only, you know, offering value, offering discount, but also brands that align with what they kind of stand for.
OK, that's interesting. So that value alignment piece is still, because that's something that came up a few years ago, but then you imagine in an era of higher inflation and a consumer that's a little more squeezed, that maybe the value alignment piece starts to fade away. But you're not seeing that.
We're not seeing that. We're seeing the value alignment play stay. We're also seeing that what they're really trying to do, consumers, is they're trying to connect with brands. So they're doing things where they're looking at not only shopping with these brands, but a great example is Represent, which is a UK brand, and they do things like they do running clubs, right? So they're trying to make sure that they connect with their consumers in a different way and really build that relationship.
What is happening in terms of, you talked about some of the categories that consumers are looking into right now, and you talked about health and fitness. What is being avoided? What are you seeing less demand for?
We're not seeing, there's not a category I can call it that we're seeing less demand for. It's really more about they're looking at categories that they want to buy, right? These are these purchases, things like items like apparel I talked about. We saw the brand Base, they had their iconic weekend bag, the luxury weekend bag that people are shopping for. We saw beauty trending, so brand Ilia Beauty was trending all over the weekend. So again, they're looking for these items, these brands that they love.
It's December the 17th. Am I a terrible human being for not having done my Christmas shopping?
You're absolutely not. There's still plenty of time.
Okay. All right. Thank you very much indeed. Deanne Evans of Shopify, Managing Director EMEA at Shopify. And some of the consumer trends as we lead into the holiday season and some of the detail there. Some of the shifting trends as well and the use of AI. Really interesting. There's a lot more coming up. We're going to set you up for the inflation data out of the UK, what to look for, and touch on the oil price story as well around this embargo of Venezuela. Stay with us. This is Bloomberg.
We expected ongoing softness in the labor market, but it isn't creating a pullback in the broad economy.
Yes, inflation is high and it's persistent, but it has been coming down.
If you look at the unemployment rate, it's true that the unemployment rate did tick up. That uptick, though, is statistically insignificant. And if you dig into the numbers and look at what caused it to go up, it's entirely driven by re-entry into the labor force.
Corporate earnings have been really the star here.
Retail sales control group number was pretty strong.
Let the doves have their day, but Thursdays, I think, will belong to the hawks.
Some of the guests we've had on Bloomberg TV reacting to that delayed US jobs report. There was something for everyone, something for both the doves and the hawks in the data that came through yesterday, both October and November non-farm payrolls. If you are then a dove, you look at the 4.6% number on unemployment and the direction of travel and you think, OK, there is the case for more rate cuts from the Fed. But from the hawks' perspective, that's not looking particularly dangerous, 4.6% level. And then, of course, you see the increase in terms of non-farm payrolls coming in above the estimates for the month of November. Yes, October was brutal, but you had the government shutdown, so that accounted for a lot of government workers. And that, of course, was a bit of a wrinkle in the data set. Things came back in November. So, again, something for everyone, arguably. And the pricing around the Fed has not materially changed on the back of the data we got through yesterday on the labour market. The US market still pricing in 2 cuts from the Fed. Let's flip the board and have a look at what to expect from the inflation data here out of the UK. So broadly, year on year, headline, you're expected to see that tick down to 3.5% for the month of November from 3.6%. Services, though, is expected to remain on hold. Services inflation has remained sticky. 4.5% is expected to remain at that level. And in terms of core, that is seen holding at 3.4% as well. The BOE, of course, makes a decision on Thursday. Markets pricing in that 25 basis point cut. But the inflation data today, of course, could adjust that view. And then, of course, we look into 2026. So the Open Trade team will be breaking that down for you when it drops at 7 a.m. UK time. Briefly touching on oil, we've seen prices up on the back of the embargo around Venezuela. It's worth noting that Venezuela produced and was putting about 600,000 barrels per day onto the market as of last month. The world consumes about 100 million barrels per day. But prices are up, at least in the session today. There's a lot more coming up. Stay with us. The Open Trade is next. This is Bloomberg.